Hi, I am Dr. Puvanendran, Assistant Professor, School of Commerce, KSR College of Arts and Science for Women, Tirchangur. We will discuss about the corporate accounting, IFRS and its applicability in India. What is IFRS? International Financial Reporting Standards are a set of global accounting rules designed by the International Accounting Standard Board. Their goals is to ensure that financial statements across different countries are consistent, transparent, and easily comparable. Applicability in India, adoption versus convergence. Adoption completely replacing local accounting laws with the raw IFRS. Convergence keeping local laws but modifying them heavily to mirror IFRS while making minor tweaks to suit that local economic and legal environment. Indian accounting standard. In Indian accounting standards are converged. IFRS aligned accounting standard implement to Indian companies under the supervision of Ministry of Corporation Affairs. Objectives to build global trust among foreign institutional investors looking to invest in Indian corporations, to minimize error, descriptions, and manipulations for financial reporting, to harmonize diverse accounting policies across different business significations. It allows Indian companies to raise capital from international stock markets without having a painful restate or rewrite their entire financial books to meet global criteria. How are Indian accounting standards formulated? The structural framework passes through the defined legality sequence: identification, drafting, exposures draft, finalizations, notifications. In Indian accounting standard 1, presentation of financial statement. The standard states out of overall framework how companies' financial statement must structured and presented to ensure that are comparable both the company's own past period and with other companies. 2. Prescribe the basis of presentation of general purpose of financial statement is a main objective. Components of financial statement: a balance sheet at the end of the period, a statement of profit and loss including other comprehensive income, a statement of changes in equity, a cash flow statement, notes to accounts. General features: accrual basis of accounting and materiality. It's a going concerns concept. Indian Accounting Standard 2, Valuation of Inventories. This standard provides the accounting treatment for inventories, which is a major asset on a company's balance sheet. The golden rules. Cost includes exclusion from cost. Cost formulas allowed like FIFO, first in first out. Indian Accounting Standard 7, Cash Flow Statement. This standard requires companies to provide information about the historical changes in cash and cash equivalents by using a statement that classifies cash flows during the period into three distinct operational categories: operating activities, investing activities, and financing activities. Indian Accounting Standard 8, Accounting Policies, Changes in Accounting Estimates and Errors. These standards enhance the relevance and reliability of a company's financial statement by defining how to handle changes in accounting rules, mathematically estimate or the correction of past mistake. Accounting policies and accounting estimates and period errors. Indian Accounting Standard 16, Property, Plant and Equipments. This stance prescribes the accounting treatment for tangible, long-term physical assets held for use in production, supply of goods, or administrative purpose. Initial recognitions, elements of cost, subsequent measurement models, cost model or revaluation models, and depreciation. Indian Accounting Standard 38, like intangible assets. The standard outlines the accounting treatment for intangible assets, which are non-monetary assets that lack physical substance but can identify and control by the company. Core concept: identifiability and control. Key recognitions rules: purchase intangibles, internally generated goodwill, research versus development pace. Indian Accounting Standard 103, business combinations. The standard governs how a company accounts for transactions where it acquires control of one or more existing business, such as mergers, acquisition, and takeovers. Core concept: the acquisition method in Accounting Standard 103 mandates that all business companies must be acquired for using the acquisition method. Structural steps required under this standard: identifying the acquire, determining the acquisition date, recognize assets and liabilities, calculating goodwill or bargain purchase. Indian Accounting Standard 110 Consolidated Financial Statement. This statement establishes the structural financial principles for presenting the preparing financial statement when parent companies control on one or more smaller companies. Core console the principles of control and the master book consolidates financial statements. Key consolidate rules eliminations, intra-group balance, non-controlling interest. Thank you.